in its entirety. All of it, every page. And I know a lot about tax efficiency now. This is one of those things that I do because no one else does it. I read the whole damn thing. It took me 2 days. It was great. And then I ran it through AI just to make sure that I knew what I was doing, and it read in 4 minutes and made the exact same conclusions. So, not a whole lot. There's a couple of different opportunities within this big, beautiful bill. We'll talk about it. It's largely built around technology efficiencies. But this is one of the things that I've always done. I've read the Dodd-Frank Act. I know Sarbanes-Oxley very, very well, and read the COVID bills. There's a lot of stuff buried in here, and it's actually very entertaining. And when we get to it, if this does get through, there's actually going to be a handful of trades. A couple of years ago, we had done something very similar where I sat down and I read this thing. And what I ultimately came to find was that there was a stock buried in the bill that all auto companies were going to be required to have breathalyzers. And a little tiny company out in Colorado, the stock went from 3 to 9.5 in 2 days. And I know Eric in Northport remembers that trade. So there are always good things when you actually understand public policy, but we're not going to talk about that right now because my brain hurts from reading that. Anyway, point being, the thing when you read this type of stuff, you're always looking for little tiny small things. When I read the Inflation Reduction Act, I found a very small 2 sentences that talked about $30 billion being allocated toward port emissions reductions, and that allowed me to start making filings specifically dedicated to the battery company that we operate up in Scandinavia. All right, today is Monday, June 30th. I'm out of my mind. I hope you guys are having a good day. We're going to run through the morning checklist. We're going to talk about the third quarter. Just a relatively simple, conservative strategy for you to run if you are new to trading. And I want to really simplify this for you. Something that if you've never traded stocks, if you've never traded options, if you've never swing traded stocks, this is something that's going to be very, very easy for you to do because the rules are very simple. And we'll monitor this on the daily show. We'll talk about these names. We're only going to do 5 of these companies, but we'll be focusing on this during our live sessions in the afternoon. If you were a member of our daily channel. Again, this will be I'll be running for free for a couple of months. So we will talk about this. And then I want to talk about risk on today. Very important because the environment that we are operating in, you fall asleep watching TheoTrade. Okay. Anyway, if you're here at 9:30, you're probably going to be late to the market. And we're going to run through all these things that are very important. What's actually engaging? What's worth your time today? Is this market safe to trade, or is it a trap day, or is it something bigger? And that's one of the key things we want to talk about today. There is something happening at the policy level that creates a lot of risk, not in the next 2 weeks, not in the next 2 months, but next year. And the sooner you understand what is happening, the sooner you're going to be able to react and prepare and to make money when this market, not if, when this market does have its next breakdown. And that appears to be coming in 2026. And I want to get out in front of it now because that does matter. It is just a matter of time. We'll talk about the smart money as well. Looking across the board right now, I will get rid of the big, beautiful bill because it is big. It ain't beautiful. But looking through the various stocks today, momentum remains strong. We got a little bit of weakness kicking in right now. But that said, we're still at 32 stocks breaking out, more than stocks that are breaking down. BA back in focus. This is one that's been bouncing around. Boeing, very strong move above that 20. That continues to generate a lot of attention on the industrial side. We were talking about this the other day with Blake, money flowing back into industrials. This is a classic later stage type of environment that we start to see before the macroeconomic conditions can become very, very dangerous for virtually everybody. But right here, as we're looking at this, strong move above its 20 and its 50 in recent days. MLI. On the downside, there's really not a whole lot in focus. The energy markets are not obviously seeing the type of breakout expectations that we were expecting in the wake of the Iranian war. So it's the tankers, the ones that were supposed to be getting all of the attention, right? All of the costs were going to expand. A lot of money was going to be a lot of ships going to be avoiding the Strait of Hormuz. Well, TNK, and some of these other names starting to break down. That's where we are seeing some weakness at the moment. In addition, just pay very close attention to WMK, Weiss Markets. That's interesting. It's interesting when we see the grocery stores start to break down, and I got to pay very close attention to that because one of the very cheap names in this space with relatively solid momentum on the upside is VLGEA. If this is one of those names that it's always important to keep an eye on. If this gets down to its 200-day moving average, VLGEA, Village Supermarket, has consistently been a buy for a short-term move higher. 29 took you to 35, 30 took you up to 38. So if this does break down, just keep it on a little sticker, put it in the top right corner of your computer. And if it hits that 200-day moving average, look for an opportunity for higher, a reversal and a move higher. This is also something just to watch on the RSI and the AMFI. You're asking about Kroger. We'll take a look at it, just to take a look at it. It is above its 20. Not really seeing anything directionally that I want to get involved in since I'm not in Kroger, but this is a little bit in a no man's land position. We just kind of came from overbought in this RSI. Strong break was back here. That was June 18th. And then the next day you had that pop. So yeah, I'm going to not be touching that. I sound like an auctioneer. I can do that. All right. So Macy's back in focus. Macy's trying to push above its 20. I would like this to get back above its 50-day EMA, but we're not there yet. Pushing on the RSI, pushing on the MFI, pushing on the MACD. This is actually a pretty clean setup for a relatively short-term trade. Possibly somewhere in the buying in the 11 range and selling at the 13 range. Very, very spread-oriented type of trade here. I'm trying to maybe retest back to that 1250 level. This is one of those things where you just set a relatively tight stop. If we break back under that 20-day, you just let the trade go, seeing if Macy's can get just a little bit of support. You don't have to buy it. You just have to trade it. And that's the key difference. I'm not worried about whether or not somebody is buying clothing at Macy's. What I'm worried about is whether or not there are algorithms that are stepping in and trying to trade this. So the fact that it is seeing that little move above that 20-day, that's important to me. GT, GENC, and JACK, JAKK. We've talked about JACK in the past, JACK specific. One of those names that if it could just find some level of strength, you start back here at around the 21 and you sell up to the 200-day EMA. Not a lot of volume. MFI not really performing the way that I would prefer, but ADX showing something there. Little life in the MACD, pushing above 50 on the RSI. I like to see the RSI push above 55, obviously, but right now just looking for little tiny moves. And it kind of speaks to just the current state of this market. As we look at this market, the key word to be focusing on in this environment is maturity, right? Maturity. We are in an environment right now where if we are to think about broad macroeconomic environments, this is where we are, what is known as late cycle maturity. Now, what does this mean? Well, liquidity or capital in the system, which is driven by central banks and driven by the hedge funds, I've talked about this, is in its 33rd month of expansion. What does that mean? It means we are in a later cycle of maturity, and it means that there are diminishing upside potential for stocks. For the market to continue to rally, it is going to need more capital. It's going to need more easing. And when it gets support from the ECB, the Bank of Japan, the People's Bank of China, the Swiss National Bank, the Federal Reserve, the Bank of Mexico, however you want to define it, this is where you get into environments where things start to stretch solely on policy. And that is very dangerous. the biggest comparison that I have seen to this environment, and remember, past performance does not indicate future gains, but what is very important about crisis is that policy drives it. The 1987 crash stemmed from valuation imbalances, currency issues, and computerized trade cascades. And why does that matter? We are in an algo-driven environment. We are in an environment where we had a Mar-a-Lago Accord that seems to be strategically weakening the US dollar. The problem with this is that in that environment, and you look at the UDN as a understanding of how much the dollar has weakened since February. The UDN is a bearish inverse fund tracking the US dollar. It has moved from 1680 to 1890 in 6 months. Now, why does this all matter? It matters because when you engage in this type of weakening, what can happen is if you just have one small policy shift, it can lead to a significant event in the markets. The 87 crash, the 08 crash, the COVID crash, the gilt crisis, the Nikkei crash last year. I'm not saying this is going to happen next week. I'm not saying it's going to happen next month, but it is starting to become a when, not if conversation. And I know that you read a lot of people, and I know you probably hear a lot of people who are very bearish. What I'm telling you is that you don't need to panic and pull your money out of the markets. You simply have to be aware that these risks exist, and it's very, very likely that in the next 6 to 15 months, we're going to see sharp decline in business activity in the United States without more accommodative policy. We are seeing easing that can lead to market volatility. So if a central bank is easing and the dollar is getting weaker, past currency accords, particularly the one in the 1980s, the Plaza Accord, precede risk event and market turbulence. This is important because stagflation risk is picking up. Inflation starts to outpace growth. Money is moving abroad. Narrowing credit spreads, firm commodities, tariff-induced inflation, and slow economic growth. This is late cycle problems for a financial system. So, with record high equities driven by a narrowing participation and ongoing liquidity injections, and even more concentration on very small number of stocks, particularly in the Mag 7. This is an unsustainable base. And once easing slows and once these things slow down, we are going to have a problem. We are going to have a problem. The key term is not today. It's not here today, but it is very clearly coming down the road. So, what do you do? How do you focus on this? Well, the one thing that I want to remind you is that the storm is on the horizon, but the dance floor is still open and just people don't have umbrellas. And it's important to now start to think about, how am I going to protect myself? Where should I be dancing? Should I be near should I be near the door? Should I be under the umbrella? Where should I be? Well, right now, you are going to be in an environment where volatility still remaining low. There's going to be a lot of opportunity to focus on more pattern-driven trading and more opportunistic trading that shows us more and more and more of these moves where you have to be opportunistic and trade into the types of behaviors that we are seeing with broad momentum. On Friday, I had a trade with the SPY. It went up very sharply, coming off of a reversion of the SPX. And I've taught this trade multiple times, and I'm going to keep going back to it in this environment. On Friday and on Wednesday and on Thursday, we had this event happen, but here you can see the SPX. This is the S&P 500. This is a measurement that is on TradingView. I don't know why TradingView does it because Thinkorswim does not. But we came off this bottom fourth deviation band of the S&P 500 index. We're getting one of these a day in the last week, which is wild to see. I just want this to happen maybe twice a week. But I came in and I bought the at the money call for the SPY, and this turned right back around and gave me something like a 35–40% gain in about 20 minutes just by being patient. Now, this is intraday options trading. This is going to pick up. This is going to be more zero date, more opportunity to make these types of trades. But at that broader back, what is the exact indicator on TradingView? Real quick for everybody in the back, when you come to TradingView and you type in the SPX, right? Just start over, just walk you through it because it's easy just to visualize it. You show up, make sure you just sign up, get an account. It shouldn't have to cost you anything. And you type in the SPX, not the index, the very top. Launch the chart. Okay. This is going to be showing you exactly where we were last week. When you get to that page, there should not be anything on it. You want to change this to a 1 minute volume weighted average price. Why did I not take the first two trades? Because I wasn't in the room to do it. To be very honest with you, I was sitting at my family's bar having lunch, and I had opened my computer at that exact moment. I had just ordered. It was $2.50. And I was sitting down there eating. I just got out of the gym and I really wanted a sandwich. And I went over there and I sat down and I opened my computer and sure enough, there it was. So anyway, indicators, VWAP, volume weighted average price. This will pop up first. Blue line, volume weighted average price, 1 minute. First deviation, the green lines. You will add with this little tiny gear, this first band multiplier and the second band multiplier. I don't know. I've never looked, Walter. I'll have to check. So I legitimately I had just gotten to the restaurant. It was 2:45. And interestingly, I would have gone here. I would have made the trade here at 2:43, but I was 2 minutes late and it had already started to move. So I didn't force the trade. I didn't chase it. And then we came back down here and I bought in the money call on the SPY. And then we took off for the rest of the day. That's the intraday. Back to my previous narrative though. Key thing here with the Mag 7, with the S&P 500, with the SPXL. I believe it is. It should be. I use the call that is in the money, right? So here's the SPX, right? There's your fall off. I flip over to the SPY. So I buy whatever is down here, and I think I bought the 611. Yeah, I did. Right? So here you go. Whatever is right there, right at the money or in the money, 610 was in play as well. I don't speculate up here. I just stay here. And I use that option looking for a reversion. That's it. Pretty simple. With that in mind, when we talk about these very significant events and how they transpire, I take you back and I walk you just briefly through what it is that I focus on, which is that big macro breakdown that transpires. So from a financial measurement point, I'm taking the number of stocks that are breaking out versus breaking down on the S&P 500. What we have found is that when that figure is very, very strong, well, the S&P 500 typically is above its 20-day moving average. It takes a lot of money to flow in. And I want, yes, zero date. And keep in mind something very simple. A lot of money flows into the market, into the S&P 500 through passive investment, specifically through the retirement structure of Americans. So every 2 weeks, you've got a lot of money flowing in and helping to provide a base and support for this financial system and for the equity markets. That is a continuing flow of money through retirement accounts. It's significant. That said, when this breaks down, when our figure breaks down, we have to pay very close attention to whether or not it is driven by the lower end of the S&P 500 or the upper end of the S&P 500. So one of the things we do is we turn it over and we look at this old friend. Again, this is telling me about debt and derivatives linked to the FANG stocks. Remember, the markets are so financialized that when debt becomes an issue for these companies, it is an issue for their stocks. And if we go back and we look at all of the measurements that we have done, even with the decay, every single major drawdown that has happened since COVID, and since we began doing these measurements, every single one of them had the FNGD breaking its 20 and its 50-day moving average. Every single one. So, here, COVID was the original. Back in 2022, this was right around the largest hedge fund sell-off in the last 15 years. 3 signals went negative to start the year in 2022. The gilt crisis is back here. Forgive me, this is 2022. This is where all the panic was. That was the start of the year. This was the largest hedge fund sell-off in 15 years. This is the gilt crisis. Silicon Valley banking crisis was right here. We pay attention to some other things as well, but bond panic, Nikkei crash, most recent crisis. Okay? So we're well positioned for whatever comes. That concentration in those top 8, 9 stocks, that's the real danger. And when those stocks go, or look like they're about to go, that's where the market really spasms. That's where the market really panics. That's where the post-cycle chaos will happen. I remind you that all of the events that I just laid out to you, COVID, gilt crisis, Silicon Valley bank crisis, Nikkei crash, trade crash, those are 5 Four Sigma events that have happened in the last 6 years. So, you don't think they're going to come for us again? 100% they will, particularly as the cycle peaks and we start to see a shift toward more defensives. And then ultimately the money will flow likely into bond duration. And then we will look for what we always look for: insiders to step in, policy accommodation, and the whole cycle starts over again. In the process of this, if we get these breakdowns, if we see these breakdowns start to happen, there are so many now financialized things that you can utilize as a trader to take advantage of that weakness, even without options. I know that a lot of people want to just utilize an options chain on a regular basis, and I get it. But if volatility spikes, what are the other tools that you can use? What are the other types of strategies that you can use? Remember, the SPXU, I know there's a lot of resistance to some of this stuff, but the SPXU is fine to trade so long as you are doing it over a 2, 3, 4 day period and you're looking specifically for weakness, and just make sure that it's remaining above its 20 and its 50-day moving average. The SPXU is one of the biggest tools, best tools to look at in periods of extreme volatility, particularly for a day trader. But if that is not your style, you know, it all goes back to the VIX. It all goes back to trading the inverse funds that are tied specifically to the S&P 500. The SH, which is just an inverse ETF of the S&P 500, went from 41 to 51 in a month. It's a 25% move up. So you don't need to necessarily be trading options. You can use these funds, or you can use just calls on the SH. But it all comes down to the timing of it. Wait until you get above these moving averages. That is the sign that something is off. Now, we've had a couple of these moves transpire in the last couple of months. Last year, this was the Nikkei crash. This was the China spasm. These were all head fakes. But it only takes one. It only takes one calculated shot. And if you time it right, because you're following these very specific averages and you're following the flow, this can turn into a very significant win in a 2-week period. You can do a lot with a $4 move on a 2-week period on an inverse ETF. A lot. And have this act as a hedge in the event of crisis. I cannot and do not know if and when this market is going to implode. All I can do is just get up each day, look at the equation, look at the chart, and have a little bit of better conviction of maybe today is the day. Maybe today is not the day. Maybe today is the head fake. Maybe this is just people trying to pull me in, pull me back into the market. Perfect example of that was what happened in March. I sent out a letter on March 12th, and I said, here comes a short squeeze. It was because there was no buying pressure. There were no breakout stocks in the equation. We squeezed, and then we dropped under our 20 and dropped under our 200 again, and then it was just chaos. Funds are well ahead of you, and you have to learn to react to them. All right. How do you trade this bull move? Well, right now, what I'm going to be doing is looking for the S&P 500 and the MFI to both move back to overbought. And then at that point, I'm going to start selling premium on my long-term positions. And as far as, like the bull move goes, the way that you're describing it, being at all-time highs, my strategy now moves in away from 3, 4, 5, 10 days out. And instead, I start to focus on what's happening at the intraday level. I start to focus on the 30-day chart. I start to look for moves where you have combined RSI and MFI under 30 on the RSI, MFI on the 20, and I look for a short-term reversal. Interestingly enough, this week I'm going to be talking about one ticker that you can trade. That's not the SPY, it's not the Qs, it's one stock. And if you're looking to learn the entire market and how to trade long-term, how to focus on intraday moves legitimately, it's this one stock is all you need to trade. And it's really been one of the very few things that I've traded in the last 6 months. And the reason for that is because of where we are, as stretched as we are in this market. So that becomes how you handle it, Lewis. In my view, you start to focus on one ticker. You start to focus on one name, something that you really can learn and you can know. And then you start taking action on that specific stock or that specific index. I've walked you through the SPX trade. In terms of a bull move, I'm looking for profit taking and then some sort of reversal. So I'm going to trade the SPY, right? Going to trade the SPY. And I'm going to look to execute around these types of moves and look for them to come once a day, maybe once every 2 days, because I believe that you're going to be able to make more off of that one move than trying to be in and out over the next 10 minutes, trying to follow individual lines. I specifically don't want to be in front of the screen the entire day. I got a lot of other research that I have to do, so I have to look and hope and aim for very specific conditions around very specific hours. Between 10 o'clock and 10:30, I'm looking for this type of move down here. I'm also looking for it at 3 o'clock because that's where institutional capital will come in, cover positions if we're down here. So that's really it. It's just narrowing your focus. Now you asked that other question. I'm going to walk you through this very quickly. The other thing is this concept of Piotrowski-Graham and trading very carefully. Do you trade both ways, puts and calls on the deviation spreads? No, only calls, only in the bottom deviation band. I never try to short. I never try to short up here. And you can sit here and you can say, do yourself a favor. Hey, Garrett, I'm going to try to short this. I'm going to save you the time and the energy. I've lost more money trying to short the S&P 500, the fourth deviation band, than any other trade in history. I've lost way too much money trying to do it because, as I've said, liquidity remains strong. News can drive things higher. I'm looking for reversion. And I am the crash test dummy on this. I have gotten smoked trying to short this. I have done very well just looking for a very short-term reversal. Can you set an alert for down to the fourth band? You can. I have not figured out or taken the time to do that. Here's the problem. You will end up being very late You need to honestly keep this chart in your top left side, have an entire screen dedicated to it, and look for it when it comes. If you see a big sell-off transpire, your first instinct should not be, hey, what the hell happened in this market? Instead, it should be to actively run to your computer, actively open your screen, and specifically search right for whatever that reversion trade is. There you go. All right. So that brings you to the last point, and that is in the Piotrowski-Graham model. This is a very conservative trading strategy. This is legitimately, I've never traded before. I'm a firm believer in fundamentals. I've read Ben Graham before. I want to understand momentum, but I also believe in value investing, even though value investing is typically dead. I want to take advantage of three major things: quality. So that means, improving metrics in the company, improving ROIC, buying back stock, paying down debt, things like that. This was created by Joseph Piotrowski at Stanford University. He had done so at University of Chicago at the time. It is a 9-point score. Very simple. 9-point score. Higher the better. What we're looking for is companies with high F scores. So we're going to look at 7. We're looking for a price to gram number. Price to gram, that goes back to Ben Graham's number. That number is the intrinsic value, according to Graham, what he is willing to pay in terms of value. Now, value has definitely gone away in the last 30, 40 years, largely because, well, passive investing, very little price discovery, and significant clustering around those top tier names. Nobody cares about the valuation of Amazon anymore. The only thing that matters is how much capital is in the system and how much support there is. It is algo driven. It is people trying to buy for $1 and sell for $1.02. That is where we are as a people. So that said, here you are, 7 on the F score, 0.8 on the gram. We're going to put our market cap at around 250,000. I'm going to raise that up to 4, and we're going to pay very close attention to where these stocks are compared to their 20-day moving average. So I take the financials out because value in banking is not tied to the gram value. It's tied to tangible book value or book value. And we focus only in the United States. And this is the list that we are provided. This is going to refresh momentarily. And here is your list. What stands out about this list is it's all heavily resource driven, right? Very heavily resource driven. And I have talked about some of these other names in the past. I talked about Korea Electric Power when it shot up above its 20-day moving average. The stock absolutely took off a couple of weeks ago, back in April, and had gone from 770 to 1430. Someone in the chat had said to me, well, this is a government-owned regulated business. And I said, I don't care, because it broke above its 20, 50, and 200-day moving average, and it didn't stop going. It became a breakout stock. It doesn't matter who owns it. It doesn't matter what company it operates in. It just took off. So we start to look for some of those names and some of those opportunities. And the things that do pop up here are actually pretty interesting. Cal-Maine is on this list. Tri-Point Homes is on this list. Taylor Morrison is on this list. General Motors is on this list. Now that is an interesting name. General Motors, which nobody wants to touch because everybody has an opinion, let me just tell you, sometimes just a little bit of improving policy can go a very long way. And as I will talk about today, General Motors has a very interesting little tax advantage that could come along the way if the BBB passes. Why? Because of the way depreciation works. This company is currently trading at a very comical level, and it is currently trading with a F score of 8.5, a gram score of 0.49. It is trading at 1.4% above its simple moving average and is hovering just above its 20-day. This is the type of stock, no matter what you think about it, that I am looking for to ride potentially back into the mid-50s. And if it stops out, it stops out. But you keep taking shots at it because it is cheap, it is well run, and the financial balance sheet will coil up and potentially lead to something more profound if this bill does pass. On that other list, Goodyear Tire, a lot of manufacturing. When I'm looking at specifically today, I'm looking for the companies that have a lot of exposure to technological investment because this bill will allow for 100% bonus depreciation this year. That is important. All right, it is 9:21. I'm going to talk about some of this stuff later today. Lewis, I'm going to talk about it today. Particularly, I will be focusing on a one-directional call with the stock, and we'll probably do a couple of spreads as well to lay this out. So various different ways you could trade GM today, and we will go from there. And again, reminder, later this week, I will be talking about that one particular stock that I prefer to trade in this environment. I hope you guys have a great day. Don is coming up relatively soon. I'm going to take the sweater off because it was so cold down here because I'm shooting downstairs. But I hope you all have a great day, and I will see you this week, all this week, 8:45 for Market Masters. Take care.